Hello and welcome to today's video, which is the usual extensive weekend one, seeking to prepare you beyond the daily perspective for what lies ahead in the days and weeks ahead. So, it's called Hidden S&P Turnaround, ? And exclamation mark. And let's delve in to the charts to find out the answers. And let me offer you quite a few previews of what premium clients are getting. You should pretty well know what is going on my site, rich Twitter feed, and Telegram for one-on-one support behind the scenes for clients. Let's start with a bit of macroeconomics, and this is the Fed's balance sheet. As you can clearly see, it's still shrinking. The Fed is mopping up excess liquidity, which is part of the reason why yields are mostly rising ever since the positioning for elections, and as well why the dollar is relentlessly pushing higher. In the preceding extensive weekend video, to which I will link at the end of this presentation, I have featured and talked reverse repos and the $500 billion boost for the final days at the break of this past year towards 2025. Right now you can see a small little dot, meaning it's approximately halfway between the highs and lows lately seen on this chart. So that's the effect of reverse repos that had been cushioning the market over the last couple of days. Treasury General account is providing and is still keeping quite enough dry firepower for what can be additional liquidity deployed to the markets. Currently, though, it isn't. So, the takeaway from the prior three charts is that the macroeconomic environment, the Fed monetary policy, is erring on the restrictive side through decreased willingness to cut fast and soon and generally disappointing the lofty market expectations. So we are seeing higher for longer creep up back into the narrative, and for all the right reasons. You remember the damage control that Daly was doing Friday following the pre-Christmas FOMC, which was one of the worst deliveries of FOMC rate cutting or no rate cutting decision, where basically I could not hear a valid reason why the Fed is cutting when inflation is starting to prove sticky. And you know what I have thought and how I had commented upon PPI CPI interaction in the latest data, and what to make of the still rather constructive PMIs, namely concentrated in services PMIs. The next chart is bringing you the 10 overlaid with 2-year Treasury yield, and we are seeing that the short end of the curve is quite having trouble rising, while the long end is putting up still its best efforts, kind of like against the odds, which in my view highlights a vulnerability of the bond market to a yields pullback, meaning that maybe, just maybe, the 4% 0.40 basis points on the 10-year might be closer than 470 or 480, but make no mistake, that would be a counter-trend rally in bonds if it develops, and it would take the foot off the equities phase in a way, and removing a headwind towards rising equity prices. But it's in no way guaranteed. It's just one chart that is worth watching. So the next one is US dollar, which I had commented on and called as more resilient to pullbacks than the yields chart is. And it has plenty of international reasons coupled with inflows into US equities or US financial markets in general, which are becoming the best game in the whole world. So that's the yields and US dollar forex backdrop of how we should be looking at equities and other financial markets. And in this video, as a reward for reviewing this in full and gathering all the insights that I wander off script, is this gold, silver and miners chart. You remember me pretty well during Thursday to call for gold to meet stiff headwinds and to start rolling over, which is exactly what had happened on Friday. We had seen miners pull back in sympathy, yet there is more rumor of China stimulus and playing around with bank reserves to free up some more liquidity, encouragements to local Chinese governments to support economic growth, and that's what can be traced to greater silver and copper resiliency Friday, where we saw a breakout attempt that held within the US regular session. So even though the gold candle has all the characteristics of just a pullback within an uptrend, I do not think that this would ultimately stick, and gold will be pressured, depending of course on the yields path. Should yields retreat, gold will have easier time maintaining these levels and slightly adding to its price gains. However, I do not see this as the most probable scenario for the week ahead. Conversely, with what I see happening in equities markets, in the interplay of sectors, whether it's risk on or risk off composition, how defensives are doing, how small caps are doing, how interest rate sensitive plays are doing, what about semiconductors and IGV sector, whether Nasdaq is starting to lead again over S&P 500, and what the financials are doing, whether industrials, meaning Dow Jones Industrial as well, have sprung to life or not. I see quite some paper assets stealing the spotlight moment ahead, kicking in at the beginning of next week, which is basically tomorrow. And what are the most important economic data that we would be facing? Let's start with Tuesday's services PMI, which I expect to come on the relatively strong side of things, meaning at least meeting expectations, and then towards the end of the week, more employment data, more job market data are coming, and these would be the defining moments macroeconomically in terms of data reaction and reading the path of US economy returning to stronger growth ahead. But the point is, and you should be asking, looking at this chart and the trends that I see in positive economic surprises lately, meaning over the last couple of months in the States, whether gold and precious metals, consider silver as gold on steroids here in this context, whether these are signaling any voracious return of inflation or not really. And I guess looking at this chart, the answer is clear. So I just thought to give you a preview of what trading signals clients are getting within their dedicated Telegram channel as well, and daily analysis and whatever they ask me to cover, and I of course deliver 100% for them to the best of my abilities. So moving on towards the weekly chart. We got Friday's closing prices and quite a distinct candlestick, which is consistent with a reversal one. Is it as good as the one 2 weeks ago? In my humble opinion, it's way better, and it's thanks to the positive developments in market breadth that we saw not just throughout Friday. That's one thing. Shaking off the retail panic towards the end of the first hour of trading and recovering and reasonably steady buying during the course of the session throughout New York lunchtime, but most importantly the power hour. That was quite a telltale sign for me whether equities meet some considerable selling or not. It could have ended stronger, but there was no noticeable selling. So the bid in the short term is there, and I'm diving into way more charts for clients. For example, the next slide I will show you in a minute, because there are quite a few points to finish on this one still. What this is doing to market breadth, whether you look at various periods of moving averages and the percentage of stocks trading above these. And following Friday, there was a notable improvement, and the nagging question that remains is whether that sticks for a day or two, or whether that sticks for a week or two or similar. And of course I will be keeping for clients the pulse on the daily and intraday developments of the market and what would be the signs that sectoral composition and intermarket would be offering us. Still on this chart you notice the noticeable rising support line in black, which is connecting the moment of Powell ruling out further rate cuts and say in early November, late October 2023, equities turning up and delivering quite predictable gains on the long side. And the other point is the Bank of Japan rate raising panic, which sank markets one beautiful Monday, early August 2024. And you see that there is still quite some room for prices to retest this line. Does it look like they would be in a hurry to do so following Friday? Not exactly, but within Q1 I do expect a rendezvous of price action with this rising support line, and when more panic over rising yields, because I stand by my call that before mid-year 10-year yield is attacking and conquering 5% mark, this would be not just tested but probably broken to the upside. So equities, in my view, and this is a bit of a longer term view counting in months, are living on borrowed time, meaning now they have the tailwind of improving market breadth, and it remains to be seen what they do with it and whether bonds act reasonable by rising, meaning yields retreating over the nearest couple of days and possibly a few short weeks. But there would be a serious correction coming during this year. So these are the key points that I wanted to make regarding this chart, and now let's move to the discussed preview of what trading signals or stock signals clients are getting within the premium stock market analysis. This represents maybe 1/3 of what I'm delivering to them, so it is still just a little preview. And this is the view of the percentage of stocks trading above their 50-day moving average. 50-day because that's what the institutions are mostly looking at, together with 200-day. It makes sense to look at 10 days or 20 days as well, but just to make the point of comparing the post-FOMC volatile upswing of 3 white candles rising almost all the way to the pre-Powell hit, I wanted to show you how this market breadth, this perspective, this one single view of market breadth, because I'm using way more, is improving on the levels where it matters, on the 50 and 200-day moving averages, meaning percentages of stocks trading above these. That it's not just on the most short-term periods of this percentage. And this is what usually lasts for a bit longer than a day, especially when we got a reasonably good, I would give it 7 points out of 10 for the closing action, meaning that we are likely to see some follow through and going for 6,000 on the March contract of ES is quite probable, I would say. So that was the preview and extensive presentation taking you to Services PMI Tuesday. Of course, I will keep releasing brief videos practically on a daily basis like you are used to. Please review the URL on the join page, which helps you select based on what and how you trade what would be the right product to make the most of my services as regards your very personal situation. Forget not about the direct one-on-one support, and as well there is way more crypto coverage on the intraday channel for the stock markets run together with Aline. Yet you are very well used to and taking advantage, especially if you are a very short-term trader. But if you are short on time and seek to capture the major moves and be aware of the macro and fundamental landscape, then I recommend to you the number 1 and number 2 option, ideally packed with the intraday channel, which is the option number 3, so as to keep connected with market moves in real time at your own convenience. You know my professional journey, very well known. Visual capturing, seeking of justice in Poland. Yeah, that's it. So beware of personators, and remember, I'm always here for you whenever you reach out. Thank you for liking and subscribing to this video, and forget not to turn notifications on. And one more reward for those who have finished watching the full-length video. Please do send me your chart requests over Telegram or within direct messages on Twitter or email, and that would be a subject of one of the upcoming videos. So thank you, obligatory disclaimer, and have a nice rest of the weekend.